Ladies and gentlemen, good day and welcome to Raymond Limited Earnings Conference Call hosted by Antique Stock Broking Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhijit Kundu from Antique Stock Broking. Thank you, and over to you, sir.
Hi, thank you. On behalf of Antique Stock Broking, I would like to welcome all the participants in the Q3 FY24 conference call of Raymond Limited. Today we have with us from senior management of Raymond, Mr. S.L. Pokharna, who is Director of Raymond Limited, Mr. Amit Agarwal, Group CFO, Mr. Sunil Kataria, CEO of Lifestyle Business, Mr. Harmohan Sahni, CEO of Realty Business, and Mr. Jatin Khanna, Head Corporate Development. Without taking further time, I would like to hand over the call to Mr. Amit. Over to you, sir.
Thank you, Abhijit. Good afternoon, everyone. Thank you for joining us today for the earnings call to discuss the results of the third quarter of fiscal 2024. I hope you would have received a copy of our results presentation. I would like to urge you to go through this along with the disclaimer slides. Now let me start with a brief overview on the market for the quarter. The quarter started on a strong note with Navratri in October followed by Diwali in November. However, post-Diwali, festive demand could not sustain and the market witnessed subdued consumer demand. The discretionary spending on fabric and apparel has been weak due to inflationary pressures and the demand remained muted. Real estate market continues to show good growth momentum, especially for the residential demand, and expect the trend to be sustaining in the coming quarters. Now let us talk about the third quarter fiscal 2024 performance. Raymond continues its growth momentum with the 10th consecutive quarter of growth, reporting highest ever performance in terms of both revenue and EBITDA. Raymond reported highest ever quarterly revenue of 2,450 crores in the third quarter of fiscal 2024 with a growth of 11% on year-on-year basis over 2,200 crores in the third quarter of fiscal 2023, and increased by 129 crores on quarter-on-quarter basis as compared to 2,321 crores in the second quarter fiscal 24. The increased revenue during the quarter was led by strong revenue growth of 50% in the real estate business and 20% in the branded apparel business. We recorded the highest ever quarterly EBITDA of 426 crores with a healthy EBITDA margin of 17.4% in the third quarter of fiscal 2024, with a growth of 22% on year-on-year basis over 351 crores in the third quarter of fiscal 23 and by 44 crores on quarter-on-quarter basis as compared to 382 crores in the second fiscal quarter of 24. The company recorded a cost of about 5.5 crores during the quarter under the Raymond ESOP scheme 2023, and excluding the ESOP cost of 5.5 crores, the EBITDA would have been higher to the tune of 432 crores with an EBITDA margin of 17.6%. During the quarter, we have almost doubled our reported net profit to 184 crores during the quarter compared to 95 crores in the third quarter in the previous year. Our focused effort and strategic initiatives across businesses helped in delivering 29% increase in revenue compared to the pre-COVID period in the third quarter of fiscal 20. And our internal drive for operational efficiency supported by effective working capital management and deleveraging initiatives resulting in doubling of EBITDA and quadrupling of the profit before tax. Now let me talk about the segmental performance for the third quarter of fiscal 24. The branded textile segment revenue was maintained at 909 crores in the third quarter despite muted consumer demand and challenging market conditions as festivities led to buoyancy in secondary sales till Diwali. However, this trend could not be witnessed post-festivities. The EBITDA margin stood at 21.6%, which is slightly higher compared to 20.9% in the third quarter last year. Now let me talk about the branded apparel segment, which showed a healthy sales growth of 20% to 437 crores as compared to 364 crores during the third quarter of the previous year. In line with our stated strategy of enhancing our distribution reach and network, focus on premiumization coupled with casualization led to growth in branded apparel business despite weaker demand. We adopted a focused approach to expand our footprint and reach of our apparel brands as well as increase ad spends to enhance the brand salience. With our strong brand equity, we are able to increase the number of doors in multi-branded outlets and large format stores, ensuring a wider accessibility and reach of our products to the consumers. The growth was witnessed across all brands, with Park Avenue, Color Plus, Raymond Ready to Wear, and Ethnics by Raymond leading the front and well as supported by Parks. The new Ethnics by Raymond brand, which offers a distinctive product range spanning across ethnic wear to Indo-Western for the special occasions and weddings, witnessed a good traction with consumers, especially during festivities, celebrations, and weddings. The segment continuously improved and delivered an EBITDA margin of 13.9% in the third quarter of fiscal 24 as compared to 11.2% in the previous year. We continue to strengthen our retail footprint as we opened 65 new stores during the quarter as well as 100th store of Ethnics by Raymond, taking the tally to 105 stores of Ethnics by Raymond as on 31st of December 2023. Our retail store network stood at 1,512 stores spread across 600 towns and cities in India. In the last 12 months, we successfully opened about 215 new stores strategically positioned across metro tier 1 to tier 4 towns across India. Now let me talk about the garmenting segment, which is in the process of expanding the garmenting capacity by about 1/3 to participate in China Plus One adopted by the global brands. Also, this capacity augmentation is in line with the Government of India's Make in India initiative. We continue to acquire new customers and enhance our presence in new geographies. During the quarter, our revenue was 281 crores, similar to previous year. During the quarter, EBITDA margin was 10.8% compared to 9.1% reported in the EBITDA for the previous year. Let me talk about the high value cotton shirting segment, where the top line grew by 10% to 214 crores compared to 194 crores in the previous year, led by demand for our cotton and linen fabric offerings to our B2B customers. EBITDA margin for the quarter was marginally higher at 10.9% as compared to 10.7% in the previous year. Now, coming to the performance of the engineering business, which is consolidated under JK Files and Engineering Limited, on an aggregate basis, the sales stood at 217 crore in the third quarter as compared to 208 crore in the third quarter of last fiscal. The engineering consumable category continued to be impacted due to sluggishness in the export markets. During the quarter, the business reported an EBITDA margin of 13.9% for the quarter. Our growth strategy in engineering sector is to participate in the sunrise sector of aerospace and EV, and we have acquired the stake in the Mining Precision, which caters to these sectors, and we expect to complete all formalities and regulatory clearances during the fourth quarter of fiscal 2024. Just for the reminder that on a pro forma basis for fiscal 2023, the consolidated revenues of engineering business, including Mining Precision business, were over 1,600 crores, with more than 60% of the revenues coming from the export business, and the consolidated EBITDA of the engineering group was 220 crores. Now let me talk about the real estate segment. During the quarter, we have been appointed as developer for redevelopment society located in Mahim West with a revenue potential of more than 1,700 crores and selected as a preferred development for redevelopment of society in Sion East with a revenue potential of approx 1,400 crores. Put together, the revenue potential from the 3 JDA projects, including Bandra in MMR, outside of our Thane land, will be in excess of 5,000 crores. During the quarter, we have launched 2 new towers at Thane land in our 10X era and in Address by GS Season 2 project. The company is running projects worth 9,000 crores on its Thane land and which has a further potential to generate 16,000 crores, making a total potential revenue of 25,000 crores from the Thane land bank over the next few years. Overall, during the quarter, we have seen a strong booking momentum and made a total booking of 428 crores in the third quarter of fiscal 24 across our projects as compared to 380 crores in the third quarter of last fiscal. Now let me provide a comprehensive update on the construction status of the various projects. The construction momentum across all 5 projects is progressing well, demonstrating our commitment to timely delivery and adherence to high quality standards. In particular, the 10X Habitat project has achieved a significant milestone with the delivery of the first 3 towers 2 years ahead of the RERA timeline achieved in December 2022. This accomplishment underscores our dedication to exceeding expectations and delivering on our commitment. In Tower 4 and 5, the lift installation has been successfully completed, while in Tower 6, lift installation is currently in progress. In Tower 7 and 8, internal finishing work is underway, and in Tower 9 and 10, the 46th and 45th floor have been completed, respectively. Regarding the Address by GS project, progress is notable with the completion of 28th and 21st floors in Tower A and Tower B, respectively. In the 10X era project, we have reached milestones with the completion of plinth slab in Tower B and the ongoing progress on the ground floor slab. Additionally, in Tower C, Podium 3 slab work is currently in progress. In Tower A of 10X era, excavation work is undergoing. In the Address by GS Season 2 and Invictus by GS project, foundation work is in progress. These updates collectively highlight our dedication to efficient project management, adherence to timelines in every phase of our construction project. Our Raymond Realty business, which offers affordable luxury apartments ranging from 1 to 4 BHK that caters to multiple segments of society, and our proven ability to execute the project at a faster pace, enabled the sales to increase by 50% to 439 crore in third quarter of fiscal 24 compared to 292 crore in the third quarter fiscal 23. The EBITDA margin stood at 22.1% for the quarter as compared to 25.5% in the same quarter last year. The margins are lower due to the initial launch cost for the new projects during this quarter. Now let me talk about the working capital and the cash flows. On the working capital front, with our continued focus on efficient working capital management, during the quarter we have been able to reduce the net working capital to 71 days, which is tad lower by 5 days on a quarter-to-quarter basis from 76 days in September 23. During the quarter, we have seen a reduction in inventory and receivables within the lifestyle business and other businesses. However, in our real estate business, we continue to launch newer towers and projects regularly where we incur initial approval costs, which leads to an increase in net working capital by 120 crore during the quarter. On an absolute term, our net working capital stood at 1,925 crore in December 23. During the quarter, we have generated operating cash flow of 333 crore and a free cash flow of 250 crore. Now let me talk about the consolidated debt position. Our total gross debt stood at 2,754 crore, which comprises of external gross debt of 1,054 crore and NCDs issued by Raymond Limited to Raymond Consumer Care of 1,700 crore. We continue to maintain healthy liquidity with cash and cash equivalents of 1,835 crore as on 31st of December 2023. Our net debt stood at 919 crore, lower by 220 crore, versus September 23 due to healthy cash flow generations during the quarter. The interest cost in the quarter is 104 crore, which is higher by 34 crores on year-on-year basis as compared to 70 crores in the same quarter last year. The rise in interest cost can be attributed to several factors. For example, an interest cost of 38 crore on the NCD issued to RCCL, which will be netted off upon the completion of the demerger, as the effective date is set for April 1st, 2023. Increased interest on lease liabilities due to higher rent expenses as we are opening new stores throughout the year. Interest of 10 crores for deferment of approval cost payment to Mahada for Bandra project. Now let me give an update on the demerger status of the lifestyle business. Based on the corporate action initiated, the proposed demerger of lifestyle business is on track and the company has received the SEBI approval for the same. The extraordinary general meeting for shareholders and other such relevant meetings is proposed on 26th of February 24. The demerger will result in two independent, net debt-free, pure-play listed entities for B2C focused lifestyle business as well as real estate and engineering business with liquidity surplus at the group level to spur future growth. Now let me talk about the current status of the operations and the outlook. The fourth quarter began with modest consumer sentiment influenced by moderate discretionary spending and the subdued impulse purchases and amid inflation. The ongoing apparel end-of-season sale saw a moderate uptick in consumer demand. In recent quarters, inflation pressures led to a K-curve recovery affecting the discretionary spending of low-income households while witnessing an increase in consumption among high-income households. We expect the trade channel to gain momentum and secondary sales, which will drive growth. Aligned with our guidance from the previous quarter, we are on track to expand our retail footprint, and over the next 18 months, we plan to add almost 250 to 300 stores with the asset-light franchise model. This expansion will be led by an increase in the store network for Ethnics by Raymond as well as for all the other apparel brands to cater to the rapidly growing market. In the real estate segment, in December 2023, we have launched 2 new towers on our Thane project, and we are receiving an overwhelming response and witnessing strong booking momentum in our Thane projects. This performance reaffirms our customer confidence and acceptance of our high-quality product coupled with fast-paced construction momentum in the ongoing projects. Auto ancillary segment is witnessing good growth. However, engineering consumables which supply through a file has been weak in the export market. Regarding the net working capital, we have been consistently optimizing the net working capital in terms of the number of days, and we will continue to maintain the same. From a cash flow perspective, there seems to be a dedicated focus on generating free cash flow through a profitable growth of the various businesses. To conclude, I would like to reiterate that Raymond Group will continue to have 3 distinct vectors of profitable growth that will create shareholder value for each of the businesses. With strong free cash flows and no major capex requirement, Raymond Group will remain net cash positive going ahead. Now, we will open the line for questions, please.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. The first question is from the line of Dipesh Agarwal from UTI Asset Management. Please go ahead.
Yeah, good evening, gentlemen. My first question is, can you throw more light on the demerger timelines? By when do you expect the demerger to go through and get listed on the stock exchanges?
Sure. So, demerger, as we said, on 26th of February, we have the EGM, and post that it will be filed with NCLT, which we expect that in the first fiscal quarter of 24-25 it will be completed. But the effective date of demerger is 1st April 2023.
Okay, sure. And any thoughts on demerger of the auto business later?
You see, we have been consistently working on unlocking the value. You have seen how we have been able to unlock the value. We want to make sure that the businesses get matured, and then we will do the right thing for shareholder value creation.
Sure. On the real estate side, if I look at the profitability, EBITDA margins are in the range of 22, 23, 24% despite own land bank. So how should we think about the profitability as you go ahead with the JDA projects also?
Yeah. Armon, the CEO is there. He will.
Yeah. So far, on an average, we have maintained a margin over the last few quarters of about 25%, barring one or two quarters where you would have seen a slight dip because we have launched new projects during those quarters. But on an average, going forward, you can expect around 24-25% margin on a ongoing basis, and it will remain steady, is what we feel, unless the market, starts doing something different.
Yeah. So even for the projects under JDA route, we will have a similar margin?
That's right. You will have a similar margin. The reason for that is actually quite simple, because given the FSI norms in the city that have come about after 2034, Thane enjoys similar FSI norms as the BMC area. But the pricing is very different. While Thane is in the range of 20,000 odd number, while the other markets that we are looking at about 30,000 or so, or slightly higher. So as a result of that, margins will be similar in both the locations, even after accounting for land in the JDAs.
Okay, sure. And what would be the timelines on launch of further projects, the three you mentioned on the JDA and the future Thane potential?
See, one of the projects that we had signed about a year ago or so, which is the Bandra project, very close to BKC, that launch is imminent now. In fact, yeah. So we have already applied for RERA registration. The moment we get RERA registration in hand, it will be launched. It is likely to be this quarter itself.
Okay. And the other question I have is on the branded apparel. If I look at the margin has improved very sharply to 14% in the quarter and almost 11.3% in 9 months. So we have seen a sharp improvement over past 2-3 years. Is there a further room for margin improvement, or most of the low-hanging fruits have been addressed?
So I think, you see, fundamentally what has happened is we have always spoken, as you get larger scale, you will continually get operating efficiency and leverage of that. And that is helping us to improve the margin profile. However, what is very important, as we have spoken number of times, that we want to put significant amount of ads so that we continue to bring more and more brand salience. As you see in this year, compared to last year, we have doubled our spend on the brands.
Yeah, okay. Hi, this is Sunil here. So I think one thing which has very clearly happened for us, and that's the area of clear focus, is that we are right now expanding our accessibility to consumers. And that is happening through expansion, all the three channels, which is our own EBO channels, which is happening through multi-brand outlets, and which is also happening through the large format stores. So as a result of this, we are getting very significant economies of scale. And that is helping us improve our gross margins. That is one source which really gives us an input. Apart from this, we are investing continuously these extra margins behind, obviously, rentals behind people, and at the same time, advertising is a very critical part, because we need to bring footfalls to the new stores. So I think that's the reason between a good judicious mix of gross margin expansion while flowing back some part of it back into brand building as well as new store opening, I think is what we are seeing a good cycle developing for us.
Okay, sure. And one bookkeeping question, the debt number which we have given in presentation doesn't include the payment for money precision, right? So that will be accounted in fourth quarter, right?
Yes. As we said, the transaction will be consummated finally in fourth quarter.
Okay, sure. Thank you.
Thank you.
Thank you. Next question is from the line of Himanshu Nair from Systematics Group. Please go ahead.
Yeah, hi team. Good afternoon and congratulations on a good performance in a difficult quarter. So sir, just wanted to understand the branded apparel business a bit better because we've delivered very, very strong growth at 20%. So would you say distribution is the key driver, or we are seeing even the like-for-like growth also trending as per our internal plans?
So I'll tell you what, I think the three parts to the lever actually, I would say, as you said, the quarter has been tough. So I would say our like-to-like growth have been much better than the industry. Because the industry we've seen has been pretty much negative in most of the results that we have seen and from whatever we understand. I think we have been much better than the industry on LTL, that's one. Second, definitely I think accessibility increase, reach increase through multi-channels is giving us a gain which is clearly a distribution-led gain. And the third part I would say is the adjacencies that we are creating within our product portfolio. For example, we have completely overhauled all our 4 brands portfolio. In fact, fifth is the ethnics one, which is the new one which has come into play. The rest, all 4 brand portfolios have been completely overhauled. We have actually strengthened our portfolio and we are seeing contribution increasing from the casualization of the segment. While we have to have 2 brands, which is Color Plus and Park, which are 100% casual, between Park Avenue and Raymond Ready to Wear, there's a huge scope of tapping the adjacency of casual wear, and which is something which we are doing in a very fast run. So that is actually an additional, you can say, an addressable market which is opening up for us.
Got it. And secondly, again, to understand the margin bit, I mean, we are already now reaching 14% margin, despite the fact that we have so many incremental ethnic stores coming in, which I believe might not be that profitable as of now, and the fact that your marketing spends have doubled. So what explains this sharp margin improvement? Because if this is the case in a high investment phase, I believe once ethnic stores start contributing and marketing, I mean, the scale moves up, then we are looking at much better, a much higher level of margins in the medium term.
Okay, see, I'll tell you what. I think for the next, couple of years, we are very clear that, as you mentioned, that we're likely to open 250 to 300 odd stores. And this will happen across 4 or 5 brands of ours, including ethnics, obviously. So I think this will be a run rate which will be including a run rate of new stores for us. We will have this cycle of opening new stores. There will be stores which get into a maturity phase of around, let's say, 18 to 24 months. They will obviously reach a much different level of channel EBITDA margins and overall EBITDA margins, but at the same time, we'll be putting back money into expanding into more stores. So I think right now for the next couple of years, we see ourselves, being on this treadmill where we get accessibility, we improve stores, we pull money back into brand building, and we continue this virtuous cycle going right now. So I think that's the visibility that we'll operate on right now.
Yeah, and Himanshu, as we have spoken few times, that we are very clear that every year we are going to spend, compared to the normal cycle of advertisement, anything between 65 to 70 crores incremental ad spend every year in order to bring forward this revenue.
Himanshu, can you hear us?
I think you can take another question. Maybe this line got disconnected or something.
The next question is from the line of Rohan from Introde Capital. Please go ahead.
Yeah, hi sir. Congratulations on a good set of numbers. So I have a question in terms of the store expansion that we saw this quarter. Out of the EBOs that we've added, which brand of ours would have seen the most expansion here, and which one would be the focus area going forward?
So actually, I think it's okay. Obviously, the lead has been taken by Ethnics by Raymond, right? Because that is a place where we have reached 105 stores now. But at the same time, the focus is across all the 4 brands: Ethnics, Color Plus, Park Avenue, and Raymond Ready to Wear. In fact, we believe that one of the low-hanging fruits for us, along with Ethnics, which is a new launch altogether, is actually Raymond Ready to Wear, because it's a brand which has got a huge consumer equity. It's got a huge resonance power with consumers, but that is something which consumers resonate more as a fabric brand. And given the quality and the designs that we are creating in Raymond Ready to Wear, it's a matter of time to get the right reach in that brand, and that brand will reach a very different level. So I would say the answer is it's by and large across all brands, but yeah, Ethnics by Raymond leads it, and I think a very potential low-hanging fruit for us is Raymond Ready to Wear.
Sure. And so it's fair to assume that Raymond Ready to Wear will also be a focus area in terms of the future expansion as well, right?
Yeah, very clearly. That's an area we'll like to.
Okay.
And actually, all the 4 brands would be, and as I said, in many of, at least 2 of our brands, the adjacency will become very important, which is getting into a casual segment. And one of the focus areas we have is that for Park Avenue and Raymond Ready to Wear, which till now have been seen by and large as formal brands, we also see a huge scope to improve, get into more and more casualization.
Okay, sir. And in terms of our omni-channel network expansion, where are we currently out of our EBOs?
So when you say omni-channel, you mean the LFS and the other channels?
Across maybe all of them, where are we in terms of percentage or, something like that?
Okay. So our overall omni-channel percentage is a double-digit number, roughly around low double-digit number is where we currently stand, including e-commerce and other parts of the omni-channel.
Okay. And I have one more question, which is on the real estate side. So out of the 2 new projects that we've announced on the JDA model, when can we expect the sales processes for these to start?
So typically, in society redevelopment, by the time the documentation is done and the site is handed over, it is about a 12 to 15 month cycle. Now, we've just begun this cycle, and if we go by the industry norm, it will be about 15 months. If we go by the Raymond norm, we hope to do it in 12 months. So, the earliest possible will be 12 months from now.
Okay, good to hear. Just one more piece on the real estate part. So so far we've done about 5 projects within our Thane land parcel, and we've announced 2 this year. So on a steady state basis, maybe how many projects can we expect within the remaining portion of the land parcel? And out of that, do we also plan to go into sort of commercial projects, or will they largely be residential?
As of now, there is no plan for any commercial project, so I'm answering that one first. While we don't rule out the possibility, it all depends on what the opportunity is. But as of now, resi is what seems to be most remunerative in terms of monetization of that land. And as far as the run rate for projects is concerned, actually, you would have noticed that we are working on a few brands that we have created. One is the 10X brand, the other is addressed by GS, and the third one is Invictus. So most of the inventory that we will be launching will be within these 3 brands, unless there is a subcategory which certainly we think is more remunerative than which won't fit into these brands. So even in the Thana land, even if we keep launching more buildings, it will be within these 3 brands. Now, while we have 5 projects, like you rightly said, but these 5 projects are all within these 3 brands itself.
All right, sir. Thank you. Good luck, sir. I'll get back to you.
Thank you. So we have Himanshu Nair from Systematics back in the call. Himanshu, please complete your follow-up question.
So what I was coming...
Himanshu, you're not audible. Can you please speak through the handset?
Am I audible now?
Yes.
Okay, sorry. So, Sunil, my question was on ethnic specifically. Now that we have 100 stores, we've completed one full season, one full year for a lot of the stores. If you can just share some store economics and how we are trending with regards to the market leader in the space, that will be helpful.
Okay, Himanshu, first of all, if you see, we have touched around 100 stores in November, right? And there are still a large number of stores which have not seen a full year cycle. One more thing which I like to point out compared to maybe an apparel brand and ethnics brand, which will be always different, is that ethnics has more seasonality than, let's say, a regular apparel brand. So to see a full potential of an ethnics brand would require a longer lead time of, I would say, maybe around 24 months, because there are times when you will just end up in a year seeing one large wedding cycle. So I think that is a piece that we are also in a very early stage realizing that will be one key way to understand the performance of an ethnic wear store versus let's say a normal regular apparel store. Having said that, I think one thing which I can tell you qualitatively, that the numbers that we set, hence I would say it's too premature to maybe judge pure play store economics right now. The things which we are now becoming very confident of, having touched our 100 store, in fact, as we talk, it's 105, is that 3 things have, I would say our proof of concept is through completely. One is that our product portfolio, which is very critical in this segment, is a winner. And that is something as a winner, I think, in a competitive as well as absolute form. We believe we have got it absolutely right also, but when we see with competition, I think we have got the right sweet spot of the target group and quality and design and pricing. So that is, I think, and that is the heart of this segment. Second, I think our store design, ambience and experience. We have done consumer research on that. I think that again itself has come out as a very, very premium, and consumers feel a consumer experience and service is very good. And the third part, the kind of traction that we've seen, and in fact, I would say this is the first true season of our ethnic stores in that sense. Because last year we were just ramping up when the season happened. We just come out of COVID. And while this wedding season also has been a bit of mixed, but within that whole 60 days that we've seen, I think we've seen a very, very sharp jump in our SPSF in those 60 days length, and that has given us, actually we are pretty confident that where we set out to, we are close to reaching that. As far as the full economics, I think maybe another cycle goes, we'll have a better handle on this. But I think we are by and large on track what we want to do.
Understood. And final question would be on the garmenting business, where we were seeing good traction for the last many quarters, and obviously we're doing a lot of capacity expansion here as well. So can you explain what explains the muted performance specifically in this quarter, and is there any change to our near to medium term outlook on this particular business? That will be all from me. Thanks.
So actually, I think, Himanshu, what has happened is in this quarter now, two things have happened. I'm sure you have heard globally, the denim market has been very, very slow. And in this quarter, we had seen a big shortfall in the order in the denim, because certain portion of this is also supplied for the denim market. Second thing, there was a certain order which was supposed to be dispatched by the end of the quarter, which has been shifted to the next quarter. However, I think very important is to see, in spite of this impact, you see, and we are expanding the capacity, we are training our staff, but we have expanded our margins. And I think that is important to see that how we are able comfortably to improve the business. And one quarter in the export business will always find plus and minus because of the delay in the shipment. I think we are very clear that the growth is intact. Even today when we talk about, we are booked out for the next 6 months. So therefore we have never seen a shortfall on the order in the main line of business, except for the denim, which was a big drop in this quarter.
And one more thing, on this, I would say is that there is a very clear focus that we have in this strategy, and which is something which we are pretty happy about, is that we see that it has been, we're doing two things here. One is we are acquiring a set of large strategic customers. Obviously, we can't tell you which ones are those because for whatever reason, but I think that's the area where we are seeing a very strong strategic partnership getting built. Secondly, new geographies are again a very big opportunity. We have always been very strong in the US, where we are looking for more customers. We have been pretty decently well placed in the UK. But what we are saying is now we have been open up new geographies like Europe. Another area of focus for us is Japan. So I think there is a pretty decent headroom of growth. Obviously, assuming that something doesn't chaotically flare up in the global economy, those are macro conditions which we can't predict. But given that other things remain stable, given that we are opening up new geographies, given that we have today a very, very strong pipeline of building up strategic customers, I think a quarter here and there happens, but I think in a mid to long term, we are very well placed on this.
Great. That's all from me, team. Congratulations again and all the best. Thanks.
Thank you. Next question is from the line of Runit Kapoor from Systematix Group. Please go ahead.
Yeah, hi team. Thanks for the opportunity. So I had a question in the real estate sector. So with Oberoi Realty launching in Thane, how do you see price hikes going forward, and how do you feel this will affect the velocity of your sales?
See, Oberoi has launched one of the projects. Yeah, that's right. Now it will not be right for us to comment on what competition is doing. We can share with you that there has been no impact on our sales. In fact, we've done better than the last quarter in Q3 also, and we continue to do so. As far as price hike is concerned, it's an equation of consumer sentiment, demand, supply, interest rates, so many factors which come into place. But having so many years in the industry, I don't think rapid price increases are actually healthy or good for the market. A stable market is always better, and which is what we've been seeing in Bombay. While the North Indian market, the Delhi and NCR market is running ahead already, but I think the Bombay market still remains very healthy with a steady price increase, not going crazy. We continue to see the same trend playing out in Thane as well as larger MMR market. It's a more mature, stable market, not too much of speculation.
And I think what is also important is to see that, look, when we launch a project, day one, we are able to book 15-20% of our launched inventory. That reflects that people come and buy into the product, and the level of confidence which we give to the customers is very, very different. Third thing, just to give you a simple perspective, from one of the reports, we have figured out that we have become the top 5 developer in Mumbai region. And the pricing in South Bombay is far different compared to what is in Thane. So therefore, it reflects that clearly our projects are selling very, very well.
So do you feel like pricing would remain stagnant for the year or two, like not much, 5 to 6% price hikes only?
See, on an average, the price hike is between 6 and 8% over the last 2 years in MMR market. I think the same trend will continue, and the Thana will not be left out. It will enjoy the same benefit. That's a prediction that we have. It's a hypothesis. Only time will tell. But 6 to 8% is, I think, very safe to assume that market will see price rise.
And the infrastructure development in Mumbai MMR region is going to support the demand, especially in the Thane, Navi Mumbai region.
So there is no supply overhang as such, while everybody talks about a lot of supply, but it comes in dribs and drabs, and the demand is still kind of outpacing, and it's very robust. It's staying ahead of the supply as of now. So there is a lot of steam in the market for the next 3-4 years.
Sure. Thanks.
Thank you. Next question is from the line of Rohan from InCred Capital. Please go ahead.
Yeah, hi sir. Thank you for the follow-up opportunity. I just have one question on Ethnics. In terms of the franchise inquiries, how have they been trending? And out of our current store count of 105, what would be the mix of franchise stores there?
Yeah, okay. So roughly around, so in the mix, we are operating on 20% COCO stores out of this mix. So that is something which we have been pretty cautious about, that I think we need roughly around 20. We would stay around this level because we also want to create some marquee stores where we can build a lot of brand building around, because if you have a marquee store which you get in, let's say a Karol Bagh in Delhi, or let's say a Commercial Street in Bangalore, then it becomes itself a kind of a collab that we have in Bombay. They become itself long-term brand building and marketing support tools. They're flagships. So I think 20% of that would go towards building stores which can drive brand equity itself. It doesn't mean that they won't break even. They would break even themselves, obviously. Hence, those properties we may want to invest ourselves. Another area we may want to invest ourselves if there are some very good mall stores that we get. And that is an area of another focus that we are looking at. Getting presence into some very, very premium malls that itself. Having said that, 20 and the rest balance is a non-COCO store is the mix that we are working towards. And your other question was, sorry?
That's it.
The other question was in terms of inquiries from new
on the franchise. Yeah, I can tell you this is one big change. Obviously, when it came out of COVID, it was a very different mood, it was a different atmosphere. I think initially people were not sure whether how we will go about this brand. I think, as I said, the confidence that we have in a matter of now 15-16 months, we have touched 100 stores. So I think that the message has gone out very clearly that we are very, very serious about it. Second, people know that Raymond has a right to win, given our equity around weddings and the way we are as a brand, which is one of the highest salience in the country. And third, I think what people have seen in terms of the product portfolio, the first season feedback, I think there's a very, very positive inquiry set that we're getting now.
All right, sir. That's it from my end. Thank you.
Thank you.
Thank you. Next question is from the line of Pritesh Sheth from Motilal Oswal. Please go ahead.
Yeah, thanks for taking my question. Firstly, I'm not sure if it's been already asked, but what's the status on Bandra launch? Was supposed to happen this quarter. And just to follow up on that, what kind of pricing that we are seeing now? Where would be the revenue potential of that project, considering now we are closer to launch that project?
So the launch is on schedule, as we had committed that it will be this quarter. So we're just waiting for the registration to come through, so it will be launched. The launch is imminent. The revenue potential was stated earlier when we had, got the project around 2,000 crores. So we are on target with that. The market has only become better since then, and not worse. So we obviously hope to do slightly better than what we had thought of. Pricing is something which you will know closer to launch one day before. Please get in touch with us. We've reserved one apartment for you.
Sure. Yeah. Thanks. Got it. And secondly, so congrats on a couple of acquisitions that we did, this quarter. Just, how should we look at, the growth from here on? Like, is there any specific, targets in mind about number of projects we want to acquire or investments we want to spend on, acquiring new projects? So you can help us understand that, how are you going ahead with the growth plans in the real estate business that way?
See, very simple. We have 100 acre of land bank, of which 40 acre has been under construction residential development, which delivers me 9,000 crore of revenue. The balance 60 acres has a potential to deliver another 16,000 crores. That will be developed over the 7, 8, 10 years. Now, we have said rightfully, right from the beginning onwards, that over the next 4 to 5 years, we are looking at it that anything between 40 to 50% should come from the JDA in the MMR region, and the balance would come from the Thane land. So we believe in the next 4 to 5 years, we should see anything revenue from the real estate side of anything between 3,500 to 4,000 crore per annum.
Right, agree. So now you have almost, 5,000 crore of non-Thane projects in your pipeline. Okay. Assuming that, that gets monetized in next, 4-5 years, that should contribute to 1,000 odd crore. So you would incrementally obviously look at projects which can contribute another 1,000 odd crore, and that development, that pipeline can be built up in next 2-3 years. What's the sense like?
Yeah. So in the next 3 to 4 years, and in this industry, it's a continuous process. So it's not something that you build once and then you stop. So each year there will be a build-up, and we are going about it in a very cautious manner. We have a criteria in terms of what kind of projects we want, what locations we want, what stage of project, and what kind of risk profile that we are looking at. And as we go forward and we launch more projects, our capacity to do maybe a different type of portfolio also will change. So the strategy can also undergo a change, which can lead to a higher growth going forward. So
sure.
We have started in a cautious way, but our response in the market has been very encouraging and pretty good in that sense. So we are very grateful for that. And going forward, we only see this trend accelerating in terms of growth. Now, it's difficult to give a number because it is an opportunistic market.
Yeah. Yeah. So just lastly, if you can help me understand, what is the initial investment that is needed from our side for Mahim and Sion projects?
Sorry, initial what? I didn't get that.
Investments. How much we have to initially pay to, I understand it's a redevelopment project, but, what's the kind of initial investment that has to go for that project? Just trying to gauge that, for by spending how much you have got this, 3,000 odd crore kind of additional pipeline.
So each project that we are assessing currently, given that the criteria that we have, we look at a peak investment somewhere between 250 to 350 crores for each project, depending on the type of project. But that's the broad range within which the peak investment would lie. And these are all residential projects, very, very strong locations, very deep markets.
Sure. Got it. That's it from my side. All the best.
Thank you. Next question is from the line of Mithun from Kiva Advisors. Please go ahead.
Yeah. So just wanted to understand in terms of your strategy with Ethnics, is there a certain number of stores that you're targeting, and what would our current kind of revenue run rate be on that brand?
So, okay, first of all, let me take the first question. I think what we are looking at is we have done a pretty good analysis of what markets contribute to what kind of percentage of branded ethnic wear in the country today, and what kind of growth rates, you can always estimate which I'd like to reach. Our estimate is that if we can reach 300 odd stores in the top tier 1, 2, 3 of this country, I think that will reach to roughly around almost 80%, 80-85% of the market, right, of the branded market. Obviously, this market obviously keeps on upgrading itself and it keeps on moving itself. So I think having touched, let's say, 105 stores today, over the next 2 years, the one big aspiration for us would be at least to reach 300 odd stores. This number can obviously change. We find a very different traction. It can go up. But I think if I were to say a good addressable market number, tier 1 to 3 or 300 gives you a very, very good foothold. It also makes you be very careful that you are not getting into markets which may not be very profitable, which may see too much of, volatility. I think this is hence a good number to target, and that is something we're very confident we'll reach. Okay. Give or take, a few quarters here and there. In terms of the way you're seeing the run rate of the store is, of ethnic store is, as I said, we've seen the first full season really right now. It's actually almost, if you see, 60 odd days we have seen, and then as we've seen, the markets have been weak, But so the ARRs in this market, again, this is a learning that we are getting very early, and we'll also learn along with also take help from you, some insight from you guys who've been tracking the sector, is that unless you see 2 full cycles, it is very difficult to call something like ARR in this industry. You will see a huge spike when the season happens, and then it will get moderated when the season is not there. So I don't think so ARR is the right way to look at it. I think, in fact, SPSF, the sales per square foot, will change a lot with define ARR. I think it's the way to see is how much you can, get, traction in the wedding season. And the second pivot, which we are trying to develop, which we believe could be a differentiator, is how do you build over a period of time less drop in a non-wedding season. I think that's another important pivot which we think one should develop over a period of time. So one area that we are working on is what we call as smart ethnics. That's another area that we are developing. It's very, very small for us right now, but as you will see noticing going forward in ethnic stores, that we think this whole consumer trend that consumers are wearing ethnic wear, not the typical wedding type, but the regular bundis, it's the regular casual ethnic shirts or short kurtas, etc., which today they wear to Fridays to office or evening wear in parties, etc. So we think that's another potential segment which will help us even out some of the troughs which may happen. So I think that's a broad direction that we are looking at.
Right. And just a question that is just seeing you also had a Raymond Home brand, right?
Yeah, we still have it. Yeah.
It's still quite visible. I just wanted to understand, is there any focus there? What sort of revenues do you clock on an annual basis on that business?
Yeah, we still have that business, and it's a good business. We have been working hard on that business. You see, there is that advertisement also. We supply to the large, MBOs and LFS stores. And we believe that it also has a great potential to grow from a current level of, let's say, 150, 160 crore revenue. We are thinking that it has a potential to also grow itself, to double itself in the next 3 to 4 years.
Yeah. I think this is an area where we will be doing more work right now, given that other areas we developed. So you're right, it's a business we are not giving up. It's a business which is an adjacency, which we believe is something where we can have a right to win. We will need to do some work on 3 areas there, and that's an area identified for the coming year. One is clearly, reworking out and maybe premiumizing our product portfolio. I think premiumization is a very important pivot there. Second is, it's a business where we have not maybe invested as of now into a strong distribution expansion. So that's another area we have identified that, okay, there's an area where this distribution expansion is a quasi FMCG in that sense, if you see, So that's an area where we are building in. And the third one, which we are clearly looking at, is there's a possibility of, some kind of institutional businesses if we can crack some models there. But, product, brand building and GTM is the place where we'll go into. This is a business which has potential. We will give more focus it in the coming years.
Thanks, and all the best.
Thank you. A reminder to all the participants, you may press star and 1 to ask the question. Next question is from the line of Dipesh Agarwal from UTI Asset Management. Please go ahead.
Yeah, thanks, gentlemen, again. My first question is, how should we think about the sales growth per square feet or SSG in the apparel business, given our distribution network would be combination of TRS and EBO?
I think, you see, we have demonstrated very clearly 20% growth, 18% for the 9 months and 20% for the quarter on the apparel. And that is reflective because of our EBO expansion as well as we are getting more and more doors. So what will happen is, this is a journey which we are on, and with the advertisement spent on doubling, this will help us to grow. And you see, the SPSF will not come from one day to another day, because as we see becomes more and more brand visible. वो कहते हैं ना, जो दिखता है वही दिखता है. So that is exactly what we are on thought process in order to grow all our brands.
Yeah, I'll tell you the three pivots. I think the question which you're asking is how do the like-to-like growth will move over a period of time. Okay, so one thing which we are seeing is that I can tell you even our current three apparel brands, the overall SPSF are pretty healthy. You know, I mean, because see all the brands, whether it's Color Plus, whether it's Park Avenue, or whether it is Raymond Ready to Wear, they have a very strong equity with consumers. What we are doing right now to enhance SSGs, one is brand building. Secondly, as I said, product portfolio expansion is a very important area which is...
Participants, please stay connected. Line for the management dropped. Ladies and gentlemen, please stay connected while we rejoin the management back to the call. Ladies and gentlemen, thank you for your patience. We have the line for the management reconnected. So you may go ahead.
Yeah, sorry, we broke in the middle. So I think this whole SSG growth will be led by category expansion, our brand building, and as a result, generation of greater footfall in stores. We are pretty confident that we will get a good mix of distribution-led as well as same-store growth combination over the years, you know.
Yeah. Would it be fair to say current growth of, say, 20%, half could be led by same-store sales growth, and half could be led by expansion?
So I think it's currently, you can say it's more skewed towards expansion because we are doing expansion across not only EBOs. I think there's another very important pivot of growth which we may not be, we don't maybe consider too often. One is the footprint expansion of EBOs, but I think there is also these brands have a lot of potential to gain market shares through multi-brand outlet as well as multi-brand channels like large format stores. So we have got into again very strong strategic tie-up with large format stores. We are doing a very large expansion of multi-brand outlet presence, and I think between these three is where this growth is coming from, and there's a huge headroom to grow for us, all the three channels. And obviously the other one which we have is, which maybe I think none of us talk about, is a very 100% captive channel that we have 1,040 odd stores in this country of the Raymond stores. Now, one area which we have expanded is that these stores have a contribution of both fabric and apparel sales. So one focus area that we have taken is that we are, how do we take salience of apparel business through our Raymond stores? Because that's a very strong brand which is built in this country over generations, you know. So there, but this one thing which helps us a lot of this casualization or this, you know, what you call smart casuals, which we're doing, that actually automatically gives us a captive 100% presence around 1,000 footprints of around 680 odd cities in the India. And given this brand building that we're doing, we expect the apparel salience in our Raymond stores to go up.
Okay, sure. And would it be possible to share brand-wise sales?
No, I think that's something which we'd not like to disclose at this stage.
Okay. And would the Ethnics by Raymond EBITDA positive at the current moment?
Right now, as we said, it's a very early days. If you remember that we are in the 100th store out of this, you know, many stores have opened in the last 6 months. So I think this, any business, you know, it has its own break-even time of over a few years. We are clearly right now at the stage of getting the right properties. We have cracked the portfolio, getting the right locations. We are tracking our KPIs very clearly. I think and we want to invest behind the brand. So I think that's the focus is on getting the growth of footprint and getting the growth of the revenue up right now, rather than, you know, getting too hacked up on immediately the better positive. This business will be an investment stage for some years, you know.
Okay, sure. Thank you.
One area I can tell you, which is that this business obviously has much different gross margins compared to apparel business. What you will see is that as we get economies of scale in this business, we will continue to expand gross margins. And again, as we said, if we've done the apparel business, we'll continue to do a very smart reinvestment of this behind brand building, behind store expansion, etc. I think this is a business which will nurture. This is a business which is an investment phase, and I think that's where the focus should be.
Sure. Thank you.
Thank you very much. As there are no further questions, I will now hand the conference over to Mr. Amit Agarwal, Group CFO, for closing comments.
Thank you very much. Look forward talking to all of you in the next quarter.
Thank you very much. On behalf of Antique Stock Broking Limited, that concludes this conference. Thank you for joining us. You may now disconnect your line. Thank you.